Welcome to Inside the Rope, the podcast where we speak to the leading minds in wealth management. I'm your host, David Clark, and today I'm joined by Tom Oriel. We're bringing you our podcast with Qiao Ma, the portfolio manager for the Munro SMID Investment Fund. Tom, welcome along to the podcast. I'm excited about this one. This is really one of your picks. I didn't know this manager. I knew the manager. I didn't know this portfolio manager. Qiao, tell me why you wanted her and why you lobbied so hard for her to be on the podcast.
Yeah, it's a good one, right, Dave? I think going back last year, I went to two events where Qiao presented, and it was right in the thick of the whole AI boom. And there was a lot of fund managers on both sides of the table, some arguing for, some against. And Qiao was, at the time, just positioning herself in the sort of the picks and shovels approach to AI and backing the hardware behind the AI boom. So it was a differentiated approach. If we then fast forward to today and we fast forward to February 2026, there was the big SaaS sell-off. Her fund, the Global SMID Fund, had effectively removed a lot of their SaaS positions, and they saw it coming and they positioned themselves well. So I just thought, with that in mind, with everything happening in markets right now, now's the time to get Qiao on the podcast. So really excited that she came on.
Well, you lobbied for it. We got her on. I think, it's a crowd space, and it's interesting to compare and contrast her thoughts, I think, with some managers like we've had on, Doug Tynan, GCQ and Edgeworth, who we've had on, really impressive managers with great track records and really articulate. It'll be really interesting to compare and contrast her style and thoughts.
Yeah, absolutely. I think one of the key stories that goes throughout the market with Qiao is that back when the iPhone 4 came out, she pulled apart the iPhone 4 to look at the hardware components within the iPhone to see what are the investable businesses that sit behind the product that everyone knows and loves. So things like that, really, really interesting. Can't wait to hear more.
Well, let's get into it. Qiao Ma, welcome to Inside the Rope.
Thanks for having me here, Dave.
Look, to start things off, as we often like to do on the podcast, perhaps you could let the listeners know who they're going to hear from today. Who is Qiao Ma?
Yeah. So I am a portfolio manager at a fund manager called Munro Partners. We manage roughly about $8 billion, and we do one thing only at Munro Partners. We try to find the best growth companies for our clients. And we really go far and wide to every corner of the world. And then we have basically one singular focus, which is find these really great growth companies. And I'm a portfolio manager for all the Munro funds. We run broadly 4 strategies. And I'm also the lead portfolio manager for the Munro Global Growth Small and Mid Cap Fund.
Okay. Now, before we break into that, I'd love you to tell me a little bit about your journey to how you came to that position.
Yeah, I've always been a finance geek. I just love finance. I sort of grew up helping my dad trade stocks. That's sort of our favorite father-daughter activity to do growing up. I got a finance degree from college, started my first job in an investment bank. Did my first job as an investment banker, went back to business school, and really just have been doing nothing but picking stock ever since. I started with fairly large hedge funds in New York, and then did about a decade of that. Came to Melbourne through marriage, and then I've been working and living in Melbourne for almost 10 years.
So which football team do you go for?
Oh, this is a tough one. I go for the Tigers.
So I have a good friend who tells me there's a whole podcast series in talking to people of note like yourself and working out who they go for and why they go for them. She's recently relocated to Melbourne, and she tells me, it's a big thing. Being in Sydney, it's not quite as big a thing, but I understand it. The Tigers. Okay, Richmond.
Well, it's actually really easy. I have a theory for that. You basically just worked out which teams were doing really well about the time they moved to Melbourne. So I moved out here. I'm like, well, there's way too much work to do research on every single team. Richmond looked pretty good to me. There you go.
Yeah. So it's like a bit when we grew up, the teams that were winning the premierships, there's a disproportionate amount of your friends who go for them.
It's
Otherwise,
exactly
they're family.
right. I think for male, it is usually the teams that do really well when you were the age between, I think, 6 to 8. That tend to be the team that stick with you.
Because you just want to win. So, Qiao, I think you're probably being a little bit modest there, and the Am I right in thinking you went to university in Virginia, and when you said you did your MBA, you did that at Harvard?
I did, yes.
Rewinding back to that, in that you're, an investment geek, and your hobby with your father was trading stocks. Now that's not a common thing you'll hear someone say with their parent. Can you remember any specific stocks or lessons you learned? I can remember. I'm 51 now, so I'm trying to think what year it was. I bought my first stock. It was Westmex, which bought a radio station. I had the paper open, 22 cents. I bought it because it was, because it was a lower price, and how many cents it was makes it better value. And you learn about these things that yo up and down. Are there any specific things that you can remember, with your father that stand out as lessons that you learned that's actually held you in good stead all the way through?
Yeah. So when I first started, I still remember the first time I saw a stock. I was actually in a small town in southern China, and my dad was like, "Hey, this really cool thing." I was probably 5, and my dad was like, "Hey, this cool thing got a stock exchange open in the town. We gotta go check it out. You're gonna love it." And I thought it was some kind of amusement park. I'm like, "Great, let's go." And I went in, and back then you could actually smoke in the stock exchange. And I was like, half the height of everybody else. It was a super crowded room. And I just remember seeing these really crazy screens, and everybody was smoking. Everybody was really excited. So that was sort of my first memory of a contact with the stock. And then for years after that, I was my dad's chartist. So that was before you really used a computer to chart the stock price. So every day I would read the evening newspaper, and then I know which stock my dad invested in, and I will chart the stock price we cleared out a wall at home, and then we put a really big piece of paper on the wall, and then I'll chart out the stock price. And I remember my very first multi-bagger for a stock that my dad picked was a TV stock. Actually, the stock is still around today. I remember the stock went all the way up to the ceiling. So at some point, I had to have a ladder to sort of climb up there to
get the scale right,
close to the ceiling. And then, of course, it crashed all the way back down to the floor. So that was a very visceral experience to quite literally climb up and down with the stock. So it was really good fun. I probably did that for a good solid decade, just sort of discussing, watching, understanding different companies and stock with my dad.
And did you develop any thesis or things that you'd say, hey, I'm really focused on this aspect of companies because of that? That TV company or any of those others back in those days, were there things you thought, well, actually real revenue counts, or real earnings counts, or, growth really counts? Can you think of anything?
Yeah, I mean, my father and I, we love stocks, but we are entirely different, sort of crops of investors. My dad is interested in much more of the technical aspect of the stock. So for him, this is all about emotions and which, every stock, if you look at the short-term price volatility, greed and fear, euphoria and despair, that's very, very much part of the stock movement. And that's really the part that he found the most interesting. So, a lot of
the technical trading aspect of
absolutely.
it. Yep.
That's why he's all about the shapes of the chart and all these like double shoulders and double bottoms, and he just loved that. Frankly, that never quite makes sense to me. So when I was a bit older, I started basically just reading every single book I could get my hands on about stocks and companies. And that's really when I realized I like the fundamental side of the business. I like to understand the financials, like what you say, Dave, instead of just looking at the chart. To my dad, every stock is just nothing but a chart. To me, this is real product, real companies, real profits. And I've just been basically intellectually drawn to that side of investing much more than technical analysis.
And if you were to look back now to yourself or someone similar to that profile now at that age, is there anything you'd recommend that they read?
Oh my God, everything. So I think I read just about any stock that I could get my hands on. I started with all the Market Wizards series. There's about 3 of them. and it basically covers traders of all styles. I love the reminiscence of the stock operator, which is such a classic tale of a human story. I've read every single Buffett books, every single Intelligent Investor, Ben Graham books, every single Peter Lynch books. Yeah, like it's all these are classics, and I will say the more you read, the more you find out what kind of investors you are. I'm a deep believer that there are literally hundreds of ways of making money out of the stock market. The trick is to work out what works for you, both intellectually and temperamentally, and that's the way to go.
Now, this interview has come about because Tom Oriel, and Tom, who's taking a bigger and bigger part of the podcast these days and been working with me a number of years, he came back to the offices and he said, Clark, you've got to have Qiao Ma on the podcast. And I said, I don't know the fund, I don't know the manager, haven't been through it. So on his recommendation, and he gave me a bit of a story about you tearing apart an iPhone to develop an investment thesis. Can you tell us a little bit about that?
Yeah. So my very first job in the hedge fund is with a fund called Co2 Management. And, Co2...
So a big, large, well-known technology investor.
Incredibly well-known today.
And did they spin out of Tiger?
Yes, he spun out of Tiger. The founder of Co2 used to be the European telco analyst at Tiger Management, and is one of the larger Tiger Cubs back then. And now is definitely a proper size Tiger on its own, but back then it's still a Cub. Co2 was roughly $5 billion. And when I joined, and it was just an incredibly fortunate timing to join, a growth fund sort of right before 2010. And that is roughly when iPhone 4 came out. And, that was really sort of a core thesis of Co2, which is the world is moving to mobile. This is a really, really big idea. Apple was a core holding of the fund, but let's not stop with one stock. Let's work out all the winners that is actually going to win alongside Apple. And really one of the best ways to find it, you just open up an iPhone, basically work out what components are in there. And then I think something that, really simple but kept us busy for a solid couple of years was basically go around and long all the components that's inside the iPhone and go and short all the components that are not. So that simple idea basically ended up making a massive amount of money, and it's a really a major profit driver for Co2 for a really long period of time, and that really stays with me. I think I shared that story with some investors from time to time because clearly we are now at the cusp, or call it year 2 of another similarly sized, if not bigger, wave. And really for a long time, you could just go after the Nvidia ecosystem and you do the exact same trick, which is what we did at Munro, not physically, but basically we tear apart, intellectually tear apart an Nvidia, Blackwell or Hopper was soon to be Rubin, and basically say what's in there, and end up sort of really doing deep studies of the components inside the Nvidia ecosystem and supply chain. So that's always been sort of a core belief of mine is when you see a really big trend, don't just do one stock and stop. Actually keep probing until you find a whole cluster of ideas and really hold on to them for a long period of time.
So I had this flag to talk about a little bit later because evidently you can't have any conversation without AI in the current market. However, it seems pretty clear to me, and it seems pretty clear in markets, that the change that we're going to see and are seeing almost daily. I think I picked up a paper or saw a snippet of Atlassian laying off 1,500 people yesterday or similar. And they were talking about AI as being the prime motivator for that. How transformative do you think this AI wave is going to be, and what do you think that the shape of it generally looks like in terms of what are the big trends you're looking for from it?
Yeah, I mean, I think to answer the first question, I think this is big. This is probably the biggest thing any one of us have seen in our lifetime. It is incredibly transformative. I think one of the things I probably would push back a little bit on is to say, people are laying off their staff because of AI. I am a really, really big believer that if you're a true user of AI and find really good use for this technology, you should be hiring, because that means your existing staff is so much more productive. And then what happens when your people become more productive? You want more of that, because that is more revenue and more profit in the door. So whenever I see a company do a massive layoff, I'm actually quite suspicious. I think there's probably certain organizational structure that were bloated to start with. There was probably a lot of inefficiencies, and then now just become a bit of a convenient cover. And yes, I get it. We need a different type of talent, so on and so forth and so forth. But I mean, genuinely, we are really excited about AI at Munro, and I can tell you, we are hiring and we're not letting go any of our investment team members.
So it was pretty clear to me back in 1999 when we were advising clients, and that, right in the middle of the .com technology boom, and, people talking about buy Telstra shares because it's the picks and shovels. And, at the same time, you could put a .com on any business name and you'd make lots of money, pets.com, china.com. These literally
I remember them. Yeah.
raised money. Yeah. And, we're right there. And I, had deals that were anchored to user numbers and eyeballs. That was a big thing. How many eyeballs does this website now have? But the point where I'm trying to get to is, it was really clear to me then that Kodak had a problem with its business and its 35 mil business. What wasn't clear to me that the winner out of that was going to be a business called Instagram, where all of my family shares photos and images that allows marketers to channel and identify to them. That just didn't seem plausible, thought of, etc. How do you think about that type of issue in light of AI, in that we can clearly see a lot of things that it's disrupting and it's going to make different? But how do you think about being able to clearly see who are going to be the winners? I was speaking to one fellow the other night at an event who founded an ASX technology company that he sold, and he's got a couple of other sort of startup SaaS type businesses going, and he said he keeps on talking to his team about, it feels like they're on a damn wall, and from week to week it's moving that quickly that they say, right, we'll just move the camp up here a little bit, and now we know what the strategy is. And then you look back in a week's time, 2 weeks' time, a month's time, and you go, well, hold on, that's all changed. We're going to have to go up the damn wall higher. That the grounding, just things are moving so quickly that setting a strategy for a SaaS software business is hard. How do you think about being able to successfully identify the winners out of this AI wave?
Yeah, so the AI wave, there are obviously a few. This is a very multifaceted question. The first thing I would just say is the AI winners are so wide and so I guess broad in terms of just how many industries are actually winning from AI, that this is a very different type of technology. It's actually a very physical technology. We sort of all worked out what AI actually need. What AI need is chips, power, and some kind of data center to house it in. I'm almost thinking about this like food and clothing and shelter for the AI. We sort of know what AI needs. So to us, if you sort of just go back to the basics, if you want to invest for the AI winners, well, then invest alongside the supply chain that is critical component into AI. Back to that, let's invest in what's in the iPhone and not invest what's not in the iPhone. So as of now, when you think about an entire power supply chain, when you go from new generation to existing power generators to utility companies to, power electronics, I mean, that is completely playing into the theme of this is something AI desperately needs, because power efficiency is just going to be more and more important. When you think about chips and networking and what Nvidia and Nvidia's partners are doing, and especially going next generation, that's clearly something that AI is going to need. So I would say if the starting point is how do I invest to benefit from AI, which I think every investor needs to do, by the way. This is such a transformational force in the market. I don't think it's possible for investors to say, I don't want to pick a camp, I don't know, and I'm going to find something that's insulated from AI. Frankly, I think that moment is over. I call it the head in the sand moment for AI is over. Every investor, you have to work out what side of the fence you're on. And if you're on the side of the fence, which we squarely are, that we think AI is real and we think AI is working incredibly well, then you go after, the sectors, the companies that's benefiting from AI today. And all these companies, by the way, Dave, they're benefiting here and now. And we can prove it with earnings growth. We can prove it with accelerating earnings growth. Many of these companies are growing earnings triple digits. So this is not an unprofitable .com, pets.com type of, pie in the sky type of growth. This is a growth that you can touch, you can put a multiple on, you can calculate, you can track on a quarterly basis. So that's one camp. And the other camp is, well, what do we do with software? Well, I think that's a really hard question. And first of all, I don't think you need to answer that question to benefit from AI, because there are a lot more just really obvious AI beneficiaries. But all these AI beneficiaries basically make software a little bit less special. And let me sort of maybe elaborate on that. So, we've all gotten used to, and frankly, the entire crop of investors that's in their, call it early 40s, late 30s today, we were all raised in the world where SaaS is awesome. SaaS is the highest quality business model there is. But if you actually step back and start looking at the underlying assumption, well, why do we put SaaS on such a pedestal? Why is it not just another industry? Well, it's
high
really
margin, sticky revenue.
Correct. Well, it's two. One is it grows fast, right? SaaS can grow 20-something% when, very few other industries can actually churn out revenue that fast. And second is annual recurring earnings certainty. It's really the last one, the durability and the certainty that get people to say, I'm happy to pay a high multiple. I'm happy to let them issue so much stock-based comp that it basically dilute 50% of the GAAP earnings. I'm willing to take all that because I love the earnings certainty and I love the earnings growth. That's really sort of the trade you're making. Well, all these sectors I just talked about, power, semiconductors, networking, you can actually now get earnings growth far greater than 20%. So I think there was a real flip in real earnings coming through from sectors that haven't seen growth for a solid 20 years. And now they're coming through. If you just open your eyes, they're everywhere around you. So you can find real earnings growth from other sectors. And the earnings durability, well, we can't answer that question anymore because you know what? And this is where the dots connect for us. We used to hold, even 6 months ago, we held all sorts of SaaS companies at Munro. And, we'll make the same argument saying, well, look at all these LLMs. They're not as good. They're just not, right? They're not as good as a vertical software that is custom-made, purpose-built for this vertical. And then the dots start to connect for us. We say, well, the LLMs that you're looking at today, they were still trained on Hopper. Blackwell, which is Nvidia's latest chip, was only launched 6 months ago. So the Blackwell trained models are dropping as we speak. So the models you see that drop over the past few weeks, those are the first wave of the Blackwell models. And then in the 1 week, Nvidia is going to unveil Rubin, which is the next wave of hardware. So you are basically living in a world where Nvidia come up with a new chip every single year, and every chip is 10 times more performance per watt, which means these LLMs are going to basically improve at a frightening speed. So if you're a SaaS, to your point, this is exactly why they have to keep moving the camp higher and higher, because not only the water is coming up, the water is coming up at an accelerated speed. And that is a scary place to be. So we basically just said, these stocks to us, we have a risk management process at Munro. It was a stop loss. It triggered all the stop loss. And then we basically sold the stocks and stepped to the sideline. So I don't have a perfect crystal ball answer to the SaaS question, but I think it's a question that that people should be questioning the durability. I think the market is right at questioning it and putting that into doubt. And, if we don't get to the answer to that, there are just plenty of other sectors to allocate your money to.
Mm-hmm. And mate, what do you think about some of the sort of, if I was to call them classified businesses? We've seen a big run on these sort of real estate or automobiles, and the argument on both sides is one, well, it's actually a network effect. The sellers are there because the buyers are there. The buyers are there because the sellers are there. Do you think that's something that AI will disrupt?
Yes, to put a simple thing. So first of all, network business on its own is not immune to technological disruption. You know what else is a network business? Local newspapers.
Sure.
Local residents read it, so local businesses advertise on it. But you know what? Local residents stop reading newspapers, and that network effect sort of breaks pretty quickly. So I think, we started doing that a little bit already. ChatGPT or Claude by Anthropic is already helping me plan my family trips. And I'm already asking them to keep an eye out for me, on the different neighborhoods that I'm interested in checking out in Melbourne. I say, hey, I'm interested in X number of bedrooms in this particular neighborhood. Keep an eye out for me. If there's an open house, let me know when. And they sort of like set that as a task every Friday. You send me a little summary of what's going on. So I think that is already happening. So I don't think there's any business at the core of it could say, human beings are never going to deviate from trying to find their information on my site. I think there is clearly a different way. We call it the different top of the funnel traffic. And that traffic is basically that one-on-one conversation between you and your AI agent. I think once that tipping point is reached, the AI agent does not care that if you list your property on the most popular site or not. The AI agent does not care if you've actually paid a premium package to bump up your listing at a more prominent window on the display website. Only humans care about that. The AI agents just care about the information. They will go to the 90th page on the search result if what you offer is basically suiting for its criteria. So, I'm not saying it's happening tomorrow, but it is a conceivable world where if you want to sell a house, if I want to sell a house, we simply just use AI to list all the basic informations, put the pictures up on any website, because you don't really care if you need to be in a major website. And then if somebody is looking for a house, their AI agent will just come find you. So in that world, where's the network? Where's the portal? So I think, again, I'm not saying that it's going to happen tomorrow, but I'm just saying it's conceivable, especially as AI agents are just getting smarter and smarter.
Yeah, makes me think about Uber, makes me think about a whole heap of businesses where you have that sort of trust or that one point that's coming through in those network businesses. How about the argument that's been thrown at, some of the naysayers that doubt the veracity of this move we've seen in markets about the circularity of revenue and earnings? The fact that, Microsoft, the hyperscalers, are placing big orders with the LLMs and the LLMs with the chip manufacturers, and it's all kind of circular, fluffing up, window dressing all of their, earnings. What's your sort of view and response to that concern?
I would say that first of all, as of now, OpenAI and Anthropic, I think the latest revenue number is the two of them are making $40 billion of annual revenue. And that is not generated from Nvidia. That is not generated from Microsoft. Those revenues are generated from enterprises. So I think, roughly in January this year, there was a real watershed moment when Anthropic actually launched a co-work with Claude. And you see massive adoption of enterprise. And by the way, $40 billion, that would basically place them as a top 3 software company in the world. And these companies have been around for about 3 years, right? So, I think that is probably one of the strongest proof point that AI is actually working. And we see real people, real situations, real world adoption of AI. And I think that is what keeps Microsoft, Google, Facebook keep investing. I think that is what keeps Nvidia really continue to invest with the supply chain. Now, the circularity is interesting. I see the cynical point of circularity, but we actually pick quite a lot of these smaller companies, especially for the small mid-cap fund, that supply to the Nvidia supply chain. And I actually see, I guess the truth is probably somewhere in between. You also see the perspective where there is so much capacity that's needed from the supply chain that if you don't have a very well funded customer to really sort of help them get started with the capacity, then it becomes really hard for these smaller businesses to go and lay down capex and really produce something and the volume that is 5 to 10x if they've ever produced historically. So you also see sort of a real incentive and actually business strategy for the larger players to lock down a supply chain. Basically, that capacity will be a lot more valuable going forward. But largely, we think the AI revenues are real. They're generating from outside of the AI ecosystem, and AI is working. And that is why some of the smartest companies in the world actually keep on really investing behind it in a very steadfast way.
You flagged there a couple of LLM companies which are private and they're early in their life cycle. Are there any companies in this space that you wish were public and available for you to invest in these funds?
Yeah, I mean, I definitely wish Anthropic is public. And I do think these IPOs are coming. It would be a fascinating time in the market when all these IPOs are coming out. So there is, in general, there is a whole list of private companies I'm always keeping an eye out for, especially running a small mid-cap fund. You're always looking at your potential pipeline, and these companies are definitely some of them.
So there's been lots of talk about private markets being bloated, and I think someone was telling me the other day that the average exit time's blown out sort of 20%. The amount of listings, particularly in Australia, I can't think of anything prominent being listed other than GYG in the last few years. A burrito business. When do you think markets will open up? And when will we see, a lot of these technology companies list, do you think?
I mean, look, I think it depends. If you're holding a defense tech company right now, I can guarantee you can find exit and the market is open for you. It really depends on what you hold. And I think it's sector by sector. And the public market is very suspicious of software companies right now. And I think, but if you look at, really ever since COVID, and this is really that vintage of the fund that needs to exit now, is the funds that were raised right around or right after COVID. And right after COVID, the only thing PEs and VCs want to invest in was software, because that was really the hero of the day. And so I think there's probably a bit of a concentration of sector problem, which is why these companies can't really come out at this point. But, if they had invested with a semiconductor company, or they had invested defense tech company or an aerospace company, the market is perfectly open for them.
Maybe can we talk a little bit about Munro? We touched on it. Perhaps you can give us a little bit of information about Munro, the funds. I think you mentioned there's 4 funds, and your lead portfolio manager for the Growth SMID Fund. Why have you ended up there? And give us a little bit of information on that. And I think, maybe you can touch on, I think you were at Cooper Investors prior to that. And I think it's the first fund that when they left, they actually closed, which, probably says a lot about your capability and skill set, that a well-renowned institutional investor like that, when somebody key leaves, they've got nobody else with that capability to do it. Give us a little bit about Munro maybe, and why you chose it, and give investors the elevator pitch if you'd like.
Yeah. So Munro does one thing. Munro finds the best growth companies for our clients. And, if you sort of listen to my personal background, that's sort of how I grew up as an investor. I really started my career with large global growth fund managers in New York. What really, really gets me excited is to find these really large structural changes in the world, and then find companies that benefit and make a lot of money out of it. That's really sort of the personal passion. I loved working at Cooper Investors, and I think the reason of leaving Cooper's was because I had this opportunity, and I've known the founder of Munro for a long time, Nick Griffin, and we had an incredible consistency in just how we think about stocks, how we think about investing, how we think about risk. So that was just a really consistent in just matching the personalities. But then I had the opportunity of starting something brand new at Munro. So in my whole career, I was either an analyst, a senior analyst, or I inherit certain strategies from predecessors, which is great strategies, great clients. But as an investor, you don't get that many opportunity to say, this is a blank canvas. How would you like to make money? What are you most excited about? And that was really the opportunity I was given. And you don't get that many of those in your lifetime. So I jumped at it. I came to Munro and basically started the small mid-cap fund. And people chuckle at my excitement at it, but I got to write the PDS for this fund. I get to pick the color scheme, the fund sizes of the fund's presentation. I get to name the fund. I end up picking a very boring name, but that was intentional because I want the fund to be just very true to label. So it's literally Munro Global Growth, small mid cap, sort of no fancy names, no acronyms. It's just it's gonna do what it says on the tin. So it was just a really exciting time. I had to wait around a few weeks for the tax file number, all these really mundane things of just starting a new fund. That was just really exciting for me personally. So I came over and did about 6 or 7 months of work getting the fund off the ground, and then get this fund started. That's really sort of how the whole thing gets started. And
how's it going today?
It's going well. Look, we started the fund in October 23, so it's 2.5 years old now. We've more than doubled the money for our investors, so we end up compounding at about 38%. On the annual CAGR basis. So it's been a really fortunate experience. But really what got us excited is when we started the fund, the thesis is incredibly simple. The thesis goes, hey, we found all these small companies that's growing really fast. Actually, they're growing at a faster pace because of all these really big changes happening to the world. And at the same time, nobody is looking at them. Like the valuation gap between the small mid-cap companies and the larger cap companies were the biggest in 20 years. And we say, well, that's pretty incredible. These small cap companies were really cheap and they're growing really fast. For a growth investor, this is pretty much the holy grail. If you find something that's growing really fast and you can buy really cheap, that is awesome. So we started the fund. And, the fund performed really well. But the interesting aspect is, when we look at the market perform of the smaller and mid end of the market relative to the larger cap market, that gap has not even started to close. So really most of the growth or the returns we've generated for the fund is really through earnings growth. The earnings just come through a lot stronger than even what we thought. The multiple catch up on the valuation gap closing, that hasn't even started yet. So that leg is still very much ahead of us. So that got us really just excited about the opportunities.
And is there anything going back to when you were writing the PDS, choosing the font size and the color scheme? Is there anything, if you could step back there and change a thing here or there, that you'd change?
Yeah, the thing I would change, I probably would have given myself a little bit more rope when the stock get big. So when I wrote the PDS, initially we said we want to cap the size because you got to define small and mid cap. So initially we said we're going to cap it at $30 billion US. And then when we started the fund, it quickly became very obvious that even when you pick a $30 billion, company to start with, or $10 billion company to start with, we've had, quite a number of multi-baggers, and quickly, they become too big and you have to sell them. So we said, well, We are a long-only fund. We have to compare ourselves to the MSCI Small Mid Cap Index. So we said, well, now we're going to take guidance from the index. We're going to drop the 30 billion because that's just too hard. We're going to, so we have to go back and change the PDS and say we take the guidance from our index. When MSCI Small and Mid Cap Index kicked out the stock into the MSCI Large Cap Index, then we're committed to selling it. Then I have to decide, well, how long do I give myself? And again, me being the author of the PDS, I said, well, I'm going to give myself 30 days because how often can this happen? It must be a really rare event. So I wrote it 30 days. And then it turns out in the past 12 months, and I run a concentrated portfolio of roughly 35 stocks, Dave, 9 stocks got kicked out of the small cap index into the large cap index. So there was 1 month, it was a really great month in terms of performance for the fund, but 3 stocks got taken away from me. So I had to go back to our compliance committee and say, I'm really sorry, but this is actually pretty hard to manage. I think I need to give myself 12 months to sell. So this is our new guideline. If a stock gets kicked out, I'm capped at the position size at which point the stock got kicked out. And then I have 12 months to gracefully and exit the stock with, in good order. So that is something I probably would have done a little smarter if I had known.
Interesting. And would you still own those stocks PA?
Well, we own those stocks in the other Munro funds. So I don't own them PA. I don't own anything PA. All my money is with the Munro funds. But we have an all caps fund. So it is quite convenient for me as a small cap manager, since all 12 of us, we manage all the funds together. So yes, I'm the lead PM for small mid cap, but I'm actually responsible for all kinds of stocks that I'm championing for the all caps fund. So when a stock gets too big, actually most of these stocks that we have to sell, they end up in other Munro funds, and we continue to hold them and we continue to make money out of them. Most of them have done very well after I exited, which is another source of pain.
Yeah. Talk to me about the process of how something gets in and out of the portfolio with those 12 people around the table.
Yeah. So everything is exactly the same. So when we started the small mid-cap fund, again, this is one of the benefits of starting a fund, because you also get to design who you want to get involved and what the process is going to be. So Nick Griffin and I, we had really lengthy discussions about this, and we basically decided on 2 things, and those become, sort of what we really stand by all the way through. The first thing is we want the entire team to be involved. We said, well, we start a small mid-cap fund, but we didn't really start a small mid-cap fund to find a really cheap coal miner out of Indonesia. Like, we are excited about large structural changes in Munro. We identified about 20 of these structural changes. We call them areas of interest. And we said, we don't want to go outside of the Munro universe. We want to just stick to the exact same areas of interest. We're just going to go deeper and go smaller and go find the earlier winners. So that's why you get the whole team involved, because every team member is already working on one or more of these areas of interest, and they are already the expert of these areas of interest. So that was the first thing we decide. From day one, every person on the 12-person team had at least one stock in the small mid-cap fund, and that is true all the way through, and it's true today as well. So this is genuinely is a whole team effort, which is a huge luxury, by the way, because most of the small mid-cap funds are run by much smaller teams, and I have a 12-person investment team to tap into, to contribute, which just means the ideas are much more broad. Then the second thing we decided is we want the exact same investment process, which really means that we have a 6 criteria of bottoms-up stock picking selection. Every stock has to be, modeled in a certain way to prove that we have earnings upside, we have multiple upside, and then every stock is managed on the other end in terms of risk management. We have that 20% fall from peak as a stop loss trigger, and then once you triggered, then the stock has to be reviewed within a week, and only when the whole team agree do we get to keep it. If not, we exit the stock, we can always come back in later. So we basically say, hey, from the stock selection, from building the actual pack, from pitching the stock, evaluating the stock, and to managing the stock when something goes wrong, on the risk management side, we just want the exact same process. So if you come into Munro tomorrow and there's a stock up on the big screen and the whole team is sitting around taking it apart and analyzing the stock, you won't know that if this is a small mid-cap fund candidate or a big cap fund candidate, because it's exactly the same way. It's the identical process. So, once the stock fits what we're looking for in the 6-step criteria, once we can prove we have massive amount of earnings upside, and we don't need to pay too much for it, then it become a stock candidate for either the small mid-cap fund or the large cap fund. And the last thing is, because the entire team is involved with every single stock pitch. So when a stock gets pitched for the first time, on a small mid cap team meeting, it becomes really obvious if the stock also fit in the other funds, because all the other fund managers are already sitting at a table listening to the pitch from day one, and then sometimes also watch the stock get managed in the small mid-cap fund for a while, go through a few cycles of earnings. So by the time they get into the large cap fund, it just becomes a really natural, organic process. I never need to repitch it again for a different fund, since the PM that make the decision has been at the table all along.
Sounds like a very thorough process with multiple points. How does incentive work for each of those managers through that? Do people have, are there clashes in that, unless I have 1, 2, 3, 4 in the portfolio, my incentive is not aligned?
It's a really good question. And I think that really that defined the alignment, that define the behavior and the culture of an investment firm. And I'm a deep believer. And look, I've worked at my share of different fund managers in my career, both in the US and Australia. I genuinely believe over the longer term, that's the only differentiating competitive advantage you could have as a fund manager, is how you align your staff, your investment team. So we have a simple one at Munro. So I'm an equity holder of Munro. So I hold an X% of Munro, the enterprise. And the vast majority of my take-home pay is the dividends from Munro. What it means is, yes, I am the lead portfolio manager of the small mid-cap fund. Yes, I'm personally championing a whole slew of stocks that I'm really deeply passionate about, and I have my own KPIs on that. But ultimately, I only do well if Munro, the enterprise, do well. What it really makes me care about is not just the small mid-cap fund. I deeply care about the all caps fund. I deeply care about our climate fund, because that's all part of Munro, the enterprise, and vice versa, right? All the portfolio managers are huge contributors to the small mid-cap fund, because this is all part of how we all get paid. Now, where it really shines is on two things. One is, if you care about the P&L of the fund, if as of now you don't have any idea that you think can actually make money, you're perfectly happy to say, hey, then back this other guy's idea, because I think his idea is going to make all of us money. That is completely okay, and we do it all the time. We just don't sit there and calculate what's my portfolio exposure, because that's really not the way to win. The way to win as a team is to let the best idea flow to the top. Let's all get behind making these massive positions, and then we can all sort of make a lot of money, right? That's sort of how you get supporting each other on an idea. But it shines even brighter when it comes to risk management. So, if you hear what I just described, when a stock triggers, you pitch it to the whole team. Now, anyone that speak up and say, I'm triggering the stock, I think we're missing something, we are committed to selling the stock. Now, if you think about on a personal level, how awkward that could be. You sit across, literally face-to-face, all our meetings, we're not virtual, these are face-to-face meetings. You sit across from your teammate who just lost 20% on the stock. He is feeling crappy. He is feeling guilty. He's not feeling very good about himself right now. He pitched a stock. He wants to defend it. And you have to be the person that raises your hand and say, I think we're missing something. And sometimes we're not even quite sure what we're missing, but I think we're missing something. I think we should step to the sideline. And for that person to not get really mad at you, hold a grudge, and the next time your stock trigger, bear in mind, we all have stock that trigger all the time. I'm going to trigger your stock out just, out of anger. We just don't have that. And the reason is, we know what these growth stocks, if you are making a mistake, right? We just went through the whole software triggers. We went through all that trigger 6 months ago. And most of the software stocks that get triggered because we help each other out, we say, I'm triggering the stock, I think you need to just step to the sideline. They were down 50% from 6 months ago. So now you look back and you say, wow, my teammate has just done the best favor they possibly can for me. And you're thanking your lucky stars, your team's got your back. And I think that alignment is the only way that you can have that full trust. We know that when the stock gets triggered, when someone speak up, that's because they want to protect the P&L of the portfolio. They want to protect Munro, the enterprise. And that's really the only way that we can sort of make the risk management process work. Otherwise, you're going to have incredible complicated issues, and ultimately you won't have your teammate get in the process and help you identify the risk that you don't see yourself.
Now, Qiao, there's always, whenever we have big waves and trends, you'll see the sort of fakes and phonies to a degree always get involved, and things always tend to overshoot. You talk about fear and greed in your father's charts. In this AI sort of wave or boom, there's bound to be some businesses that position themselves as top quality AI beneficiaries that aren't really. And you've talked about Munro as being a long-only investor. If you were hypothetically to be a short investor as well, are there any categories of companies that you can see in that AI wave that you're not so sure of that you'd be happy to short if you're a short investor?
Yeah, so first of all, one of our 4 funds is actually a long short fund. So we do short. And I also grew up in the long short world. But shorting, frankly, is quite complicated so far. Because there was just a debate, right? As of now, there was much more of a debate than sort of a real evidence base that you can sort of go after and say this sector is toast. But at the same time, AI is also a massive tool that is available to all. So in some ways, it actually adds to the risk of the short in some ways if that sector or that company can actually turn around by using AI in a really smart way. But there's always companies that we're short, and some of the non-tech sectors that we're short. So for a while, we were short sort of legacy human resources companies for the disruption of AI. We were short legacy retail for quite some time, some of the ICE automakers. So we're always shorting a whole variety of stocks. And I do think that over the next few years, the way that the market is structuring, it is going to be a long short in some ways. It's a stock picker's world, in the sense that you're right. There will be massive winners that gets created, which means your conviction will be awarded. But at the same time, I think the performance could be very divergent, even within the same sector, which means if you have conviction on the short side, this is just a really good market conducive to that kind of long short winner loser thinking.
Qiao, you've been really generous with your time. I love the arc of your career path. Congratulations. Fantastic to have another female on the podcast. We love to claim we're talking with the leading minds in wealth management, which I think you obviously are. And it's great to be add your name to that list of podcasts. You've been generous with it. What haven't I asked you that I should have?
Oh, my God. I think you've asked most of it. I think maybe the one thing you haven't asked me is valuation. And this is sort of interesting, and especially when you sort of put it in the perspective of public and private.
Does it matter?
It matters greatly.
I like to hear that. One of my partners, we're in one of our investment meetings here at Coda, and there's some areas where we've trailed, and he said, if we're guilty of anything, it's believing that valuation matters.
Well, valuation matters greatly. And I would almost say, if you think about the duration of visibilities has shortened because of the technology change, well, then what can you fall back on? You can fall back on valuation. So I think valuation absolutely matters. I think this is actually one of those rare situations in the market where, and that's why we're excited about the small mid-cap fund, but even the larger cap space, we've seen real earnings grower that we don't think they are the phony fakers. We see proper earnings, cash flow coming out of a business that they're using it to buy back or to buy other, competitors consolidate the industry. And we actually see really compelling valuation in the public markets. So I think that's that could be another reason why some of the private companies are having a hard time coming out, because I do think valuation matters. And then we are at a time where you really can find really fast, proper growth companies that, in my way, take all boxes that still are trading at really valuable and really reasonable valuations.
Qiao, thank you very much. You've been so generous with your time. Congratulations on the fund to date. The font colours look at the font and the colours, everything looks fantastic.
Thank you.
Congratulations. Thanks for joining us in Inside the Rope.
It's great to be here. Thank you for having me.
Welcome back, listeners. I hope you enjoyed that as much as I did. It's not often I walk out of this booth and with a big smile and tell one of the colleagues here how impressed I was with the conversation. Tom, what did you think of that?
Really, really interesting. It's funny because I had a look at your notes and I had a look at mine. I think there are a few things we've both noted down, so I don't want to steal your thunder at all. But look, I think the first thing that stood out to me was just her youth, growing up with her father, plotting the stocks on the wall at home and watching them and tracking them as they progress.
It's a cool career arc, isn't it?
Absolutely.
Great backstory.
Yeah, and it shows that she has a deep respect for the technical analysis piece, right? Which is funny because she talks about the fundamentals of these AI businesses and that they're backed by real cash flow, real earnings, they're sustainable businesses. They're not just high growth, sort of hyperbole businesses where they're trying to raise new cash every quarter.
Let me tell you a little story she told me sort of off air, which I'm sure she won't mind me telling. And I apologise because I think I got her name incorrect and I said Qiao Ma, it should be Qiao Ma. So apologies for that. But she said, look, of course, she was very, very excited when she got offered after Harvard Business School that she got offered a job with Coatue, this sort of one of the world's great hedge funds in technology that had spun out of Tiger with a great track record. And she rang her dad and said, "Oh, Dad, now that I've finished my, Harvard Business School, I've been offered a job with Coatue." And, he sort of said, "Well, who are they and what do they do?" And then his response back to her was, "Well, what did you need to go to business school to pick stocks?" From his point of view, it was just like a bit of a hobby on the sideline. He's an engineer and he, had this sort of passion for following and investing in his technical capability. But yeah, nice little side story, that back arc of her career. There's not a lot of it, and I think we're going to increasingly see as the availability to information, you think it's only been the last sort of 10 years that we've had, all of sub-Saharan Africa, all of China and developing Asia with the access to the internet. So, I'm not sure it's my kids growing up in the cushy suburbs of Sydney that are really motivated to do the extra yards and tear apart the iPhone to find out the investable parts of it. I think we'll see people like Qiao coming through increasingly, and it's terrific.
Yeah.
What else did you get out of it? What were the big takeouts?
There are loads of big takeouts. I have so many notes. The other one, quick point that I'd flag is that I just loved her favorite books, Market Wizards, Reminiscence of a Stock Operator. So that whole respect for technicals, and then paired with, but Ben Graham, Intelligent Investor.
The deepest fundamental, the starting book for all investors.
So some of my favorite books, really, really good. The valuation piece she spoke about, but then the SaaS question. I think this is sort of the more defining moment in the episode, and what she touches on there in how they saw it coming. They had their stop losses triggered, and at Munro, for people that know the fund well, they have these really, really strong stop loss measures in place where if things hit that, anyone at the investment committee can shout out saying, we need to get out of the stock. So they exited those quite quickly. She's not sure about how sustainable the earnings are in some of these SaaS businesses, given the AI movement going forward.
Yeah, the big thing I took out of it was her view on the network companies. And we've had, a lot of thinking, a lot of conversations, and I think there's been some investors in this space who have owned the real estate.coms and they're, the car sales where the value in the business is the fact that all the sellers go there because all the buyers are there, all the buyers go there because all the sellers are there. So you've got this network effect. She's not so convinced they can be dislodged. And she gave that example, that, she's now got her AI bot once a week sending her an email of all the properties that fit her profile in Melbourne, and that bot will go to the 10th page in the bottom, unlike us humans that only go to the front page and probably the very top REA listing. So you'll be able to post your house on the local, Ray White, whoever it is, in Yarra Yarra, and it'll be just as findable as REA. So you may not pay the 20 grand, you might pay $200, for someone to load it up. So that whole questioning of that network style business and how AI might eat the lunch there, I found was really unique and super interesting.
Yeah, exactly. And to your point earlier, this whole information boom, it's fascinating to think about how people are going to absorb all of this information and then what's going to be in place to then filter through it and categorize what is the most appropriate information. We think of LLMs and AI and how it works. It's a big probability calculator. And so making sure that's fine-tuned to ensure they're getting the right outputs and who's navigating that. It's really interesting to see how these SaaS businesses navigate that and retain their earnings.
Super early days, but her performance has been fantastic. We didn't discuss, it's one of these conversations I looked down and we're closing in on an hour, but I could have gone for another hour or two really easy. And I came in this morning and had a look at what her top sort of 5 contributors were, trying to get an understanding of what they're actually investing in, what they're making their money out of. And I see, her top contributor for either last month or quarter was TKO, which owns UFC and
That's
WWE,
right.
which I kind of like. I was so far from
the new F1. Yeah.
Cena Corp, which is optical networking equipment and software. So that kind of plays into this area of being tangential to AI. That's going to do well from it. And then PWR, or Quanta Services, specialized engineering and procurement. This multi-decade infrastructure build out that we're seeing, because the use of, it's so much more power intensive to do an AI search than it is a normal Google search. So that's kind of interesting. I thought the other ones rolling that out was GFL Environmental. And on the bottom side, I think she was holding Reddit, which we all know that business, Reddit, Interactive Brokers, which we have come across, a system online for trading in the US that's used by a lot of managers for custody and so forth, some small fund managers, Heiko Corporations, Aerospace Defense, and Futa Holdings, online brokerage again. So it's interesting, some of those positions they're playing out, but those names are companies I'd never really heard of or seen. I knew the underlyings for WWE or UFC or whatever it is, but it would seem that's quite diversified. Early days performance has been fantastic, but it's hard with these managers. I always hear them and say, gee, they sound great, and you walk out going, wanting to give all your money to them. But she had the experience that she's had at multiple different places, backed with the structure of Munro. I kind of like the look of this, and I'll be following closely into the future.
Absolutely. And
thanks for the suggestion.
No, you're welcome. I think the last point to make on that is that she's only seeing the pipeline getting stronger. She's seeing a big backlog of these private businesses in the AI space saying, when are they going to IPO here? Like, she'd love Anthropic to be public, and positioning their fund in a way that can capture that if they do list.
Well, the other thing now you've mentioned it is she mentioned that some of her best investments she had to give up. So, hey, be alive to the fact that, people think, I'm just this fund manager, they'll invest me in the best stuff and their best ideas. Well, no, it's outside of mandate. So you've got to be cognizant of that. And she also mentioned that the upswing in the portfolio has all been earnings driven. So there's been no PE expansion or no multiple expansion, which she expects to come as well. So, early days, but some green shoots for sure from that fund, and, a star performer for the future. I really enjoyed the interview, the conversation, and really look forward to tracking her career, which I'm sure will be long.
Likewise.
Thanks for suggesting it. That's why we got you around.
Absolutely. Thanks, David.
Thanks, folks. Thanks for joining us. Hope you enjoyed the episode. Remember to listen to the disclaimer at the end of the podcast. And email me if you want to, david.clark@codacapital.com. Thanks for watching.
Thank you for listening to Inside the Rope with David Clark. Be sure to subscribe to this podcast on iTunes. You can connect with David by visiting codacapital.com. Any views expressed in this recording represent the personal opinions of the speaker and do not represent the view of any other party. If this recording contains reference to any financial products, that reference does not constitute advice or recommendation and may not be relied upon. Listeners in Australia are encouraged to visit www.moneysmart.gov.au to obtain information regarding financial advice and investments.